Coming up today, the S&P 500 closes at a brand new all-time high. What's really driving stocks now? Are we really still dumb money? Google rips higher, the latest on inflation, and is 2025 a slingshot year for stocks? You're going to enjoy this one, guys. Let's go. Well, it was a pretty decent finish for stocks here. S&P 500 up about 0.5% once again, led by mega cap tech. We got Nvidia hitting brand new all-time highs, and it was actually Alphabet Google doing the best today out of the group. But industrials also showed up along with consumer cyclicals. It was actually defensive sectors, along with energy and healthcare that were softest today, and a bit of a mixed tape. But we officially did it. Brand new all-time highs on the S&P 500 index. 61.73. Markets absolutely ripped up this week. Shook off the drama in the Middle East as though that was actually a de-risking event rather than anything to worry about. It's blue sky territory now. No overhead resistance. And even though we just broke out to brand new all-time highs, the market still isn't that technically overbought, nor is sentiment and positioning. Fear and greed index just in the middle of the greed zone. Typically don't get those short-term tops until it goes above 70 and into extreme greed as well. And in fact, this week we're still seeing elevated bearish sentiment while stocks are at brand new all-time highs. But that is completely normal for bull markets as we climb what's known as the wall of worry. I've seen this time and time again with stocks breaking out and a lot of people skeptical, pessimism on the sidelines. That's what gives a bull market further legs to run because all those people eventually come back in. But if you wait for everything to be perfect, like there's no risks out there and everyone's bullish, that's when we're typically more closer to a top. But the fact is we're getting some of the most bullish technical price action you'll ever see. And that's a strong rebound after a sharp sell-off. And in fact, we've just posted the strongest rebound in history. S&P 500 gained 9% this quarter after falling as much as 14%. And that's a true outlier looking at previous recovery. And just to illustrate that on the chart of the spider here, and we'll just go out to a monthly chart and we'll drop off all the indicators so we can get a better look and we'll go logarithmic. You should always look at a logarithmic chart when looking at data more than 10 years. And so let's just zoom out, look at this entire secular bull market that started in March 2009. And even though we've had technical bear markets in 2020, 2022, and in fact, we even dropped 20% to start this quarter off, which some people call an official bear market. But to my eye, these are simply just correction and what looks to be still a strong secular bull market. And I mean, look at that tail. And let me just go to normal candles here instead of volume candles so we can get a good look. Look at that recovery in April with a long wick there, almost like a hammer candle formation, which just shows how fast the market sold off and how fast it got bought back up. And here we are at brand new all-time highs. And it's funny seeing the US president actually call the bottom like he's done a few times. Even back in his first term, market sold off hard late 18. Into Christmas, he said it was a glitch in the market. And I think he does this because there's probably at least 100 people close to the president. I'm not talking his inner circle, but assistants, administrators, etc., that can pick up wind of policy and other things that could be actually leaking it. And instead, he wants to give his followers a heads up by coming out and doing the same thing. And we've seen this a few times. So it's not really inside information if it's been shared publicly. And you can't argue with the technicals. And these just add further weight to some of the fundamental tailwinds we've got going on. Last month was really strong, up over 6%. Looking back in history, markets are higher 12 months later, 100% of the time, with an average gain of almost 20%. That is significantly high. And in another technical pattern, which shows the speed of this recovery, but just isolating the S&P 500 when it's had a 2-month gain of 20% or more. Once again, we're higher 100% later with huge average gain of 30%. And so that's kind of like a momentum thrust signal. And 2025 may actually turn out to be a slingshot year. And that's when a market recoils and then fires off, which we could be potentially on the cusp of doing. Looking back in history, when the S&P's been down more than 7% during the first half of the year, but finishes the midpoint of the year higher, like we're about to do come Monday, the last day of June, the last day of Q2. The final 6 months of the year are higher 75% of the time. And if we don't get a recession, the final 6 months come in with a pretty healthy return there of 11%. But what do you guys think about that? Let me know in the comments below this video. And I know these are small sample size stats, but they do illustrate the characteristic of the market and what it's done. Looking back in history when the S&P is down more than 18% from highs and then gets back there within 3 months. In other words, a fast recovery. Again, 12 months later, we're higher 100% of the time with healthy and well above average 12-month gain, 21%. And so there could still be a lot further to run. Even though the third year of bull markets can be a little softer than the first two, the last 2 years we've had are actually still below the average year 1 and year 2 returns for a bull market. And just looking at the S&P 500 and its relationship to the VIX volatility index, when the S&P hit a brand new all-time high, we're kind of around a midpoint, with the VIX currently just above 16. Interesting to note, back in the mid-late 90s, a roaring bull market into March 2000, market kept hitting new all-time highs, years, but the VIX kept on increasing. A much different bull market, 2013 through 2019. We were grinding higher on very low volatility, both realized and implied. In fact, we saw the VIX get down to an 8 handle. And so you can see the events in 2020 really uncoiled volatility, massive crush into 24. Then we spiked again on the tariff drama, and we've come off somewhat here today, but we do have plenty of room to grind lower. And even though we still don't have the best market breadth, the percent of stocks hitting new all-time highs, still quite low. We have seen this pattern before in recent years, especially looking at 23, going into 24. Stocks broke out to brand new all-time highs on similar levels of market breadth, measured by percent of S&P stocks hitting brand new all-time highs. And that's because the index has become a lot more top-heavy, mega cap tech really driving the gains. And this could actually be more reason for a melt-up when more and more stocks jump on board and hit brand new all-time highs as well. Still got a lot of growth, high beta stocks off their 2021 highs. And like I said before, some people are calling that correction we had into early April a bear market because technically the S&P 500 came off more than 20%. Now it's interesting to see this chart today showing we could be only 2.6 months into a brand new bull market. But like I said before, in my mind, we're still just chugging along, and now a 16-year-old secular bull market that could be going into its final melt-up phase, in which bull markets typically see the best annualized returns. A lot of bubbles can give half or more of their total returns in the last 10% of the length of the entire secular bull market. But what about for the here and now as we go into July next month? Well, it's interesting because stocks have actually gained in the month of July for 10 years in a row now. That's only been eclipsed once back in the late 50s, 11 positive Julys in a row. Are we about to do the same again? Well, I'd say there's a good chance because we've got what I'd say the most important stock in the market hitting brand new all-time highs, close to a $4 trillion market cap. Nvidia, as the most cashed up companies in the world, can't buy enough of their high-end AI chips. With the stock now on a 5-day win streak, having recently shaken off all concerns and risks to do with China. Anyone remember DeepSeek? And apparently they built a GPT killer with a fraction of the chips. Well, it didn't really turn out to be true. Surprise, surprise, right? And that was back there on the 27th of January, earlier this year. Stock sold off, accelerated with the tariff drama, actually getting down to the high 80. And like I said, back then it was great value. That's why I was buying myself at $103 a share, like I told you guys. And they just came out with a great earnings. And as I told my members, I expect them to hit all-time highs again soon, which they've done again today. Now with a market cap of $3.85 trillion. And that's versus Microsoft, $3.69. And like I told my options trading members earlier this week in our chat room, thought it was a good bet on Polymarket, as they were less than 1% behind Microsoft, and I managed to slap on a bet when they were showing just 28% odds. That's currently now 96%. And as long as Nvidia doesn't have a dramatic fall on Monday, June 30, that should pay out $500 for me. But more important than a side bet is this overall secular trend that's accelerating, in my opinion. Just looking at this data here, the percentage of firms expecting to use AI in the next 6 months. Look at that, it's ripping more than the stock price of Nvidia. This time last year, it was 6.7%. Here we are at 11.6%. That's over a 50% gain in the percentage of companies planning on to use AI. It's having real material effects on businesses across the world, helping to drive productivity and profit margin. And that's just one of many mega trends helping to drive this market. Another big one is the regulation of cryptocurrency and stablecoins being recognized as a legitimate asset. Such a big change from where we were just a little over 6 months ago. We previously had an SEC that was coming after this stuff and a federal government kind of caught in the middle. But now that's dramatically changed and there's huge political and regulatory tailwinds. And that's why Coinbase has been a true standout these last couple of weeks. Even though it's having a bit of a pullback today, we've just seen these monster volumes coming in, which looks to me like big money. You typically see this at the start of big trends, coming off bases and consolidations, these big momentum thrusts on huge volume. But it's not just AI and crypto, tech overall, with IPOs really waking up of late as the market for new equity has been somewhat stagnant and really quiet these last couple of years. After a hot 2021, we're seeing a lot of new activity, a lot of exciting companies in the pipeline about to come onto the market, in addition to investor enthusiasm. And this is what you want to see in a bull market. New hot IPOs do really well, and we're seeing that right now, especially in tech IPOs, with CoreWeave and Circle just being two of the latest examples of new hot stocks screaming right out the gate. But it's not just speculation and investor enthusiasm. There's real fundamentals behind this market. Stocks can swing around a lot in the short term based on sentiment and liquidity, but long term, they're really driven by earning. And the fact is, we're on track for another healthy gain in earnings per share this year for the S&P 500 expected to accelerate again next year. And I'd say AI is a big part of this, helping to create new products and squeeze corporate profit margins higher. Add on top of that investor enthusiasm, and you get that multiple expansion, and that's what delivers big gains. Both EPS and multiples growing in tandem together. And so I get it. The bears will constantly remind you that the forward 12-month PE is near 10-year highs. It's almost 22. But let's just think about that for a second. What does that imply? That implies a forward earnings yield of a bit over 4.5%, and that yield's growing at 10 to 20% a year. Now remember, you can't look at stock valuations in a vacuum. Everything is relative. You got to think of interest rates as like gravity in financial markets. So you can invest in stocks and expect to get an earnings yield of 4.5% next year, or you can lend your money to the government and get 3.74% over the next 2 years. And that's not growing, and in fact, that may even be on its way down. And in my mind, if we are going to go into a final melt-up phase of a secular bull market, or who knows, we've seen 23-year secular bull markets before. We're 16 into 1. Some say we're only 12 into 1 because the S&P didn't break out to brand new all-time highs until 2013, taking out highs from late 07. But guessing when the secular bull market is going to end, I mean, it is entertaining, but if you're going to base your entire wealth off a guess, you really do need luck. Because in my mind, for it to really signal a melt off top, I'd say this forward PE has to break out to new all-time highs and who knows, even hit 30 or something we've never seen before. Because markets typically top on peak valuation, sentiment, and rates, all three of which we don't currently have. We've got good momentum, we've got pretty firm valuations, but forward PE 22 is not all that crazy in a 3.7% interest rate environment, in my opinion. And I think it's actually more risky to not be invested. If you're in cash or short-term bonds, you're basically short inflation, short the supply of currency, missing out on yield, etc. And I think that's the issue with a lot of people. They may not know it, and especially if you're under the age of 50, they're far too conservative. They need to actually take more calculated risks. And if we're going to go into this true supernova bubble, it's going to be driven by the likes of you and I, active retail traders, headed up by Vlad Tenev, the CEO of Robinhood, who I think is shaking up the whole financial industry. I know it sounds crazy, but I think Robinhood could be one of the biggest, if not the biggest, financial company in the world within 10 years. Millennials are the future. This is the most popular app with millennials. They're expanding into a number of new products. They're expanding around the world. They have great customer feedback. There's nothing more scalable than a smartphone app, and they've got huge network effects. And just like Coinbase, it still hasn't broken out of its 2021 highs, although we've completed a massive base. And just like Coinbase, it's still got a market cap below 100 billion, 73 billion. And just to give you some relative perspective, biggest bank in the world, JP Morgan, has got a market cap of 800 billion. Plenty of room to grow. And in my opinion, retail investors aren't going anywhere. We're just getting more and more powerful and having more and more influence on the market. But the media and plenty of others online still label us as being dumb money, when in fact I think a lot of us are actually outperforming the so-called smart money, most of which struggle just to keep up with the market. But like I said, the fact is now we make up a bigger portion of the market's daily trading volume. According to a report from Jefferies, yesterday, they said retail trading accounts for about 20% of total volume. That's compared with less than 15% for hedge funds and long-only institutional investors. And so let that sink in. Us retail investors now account for more volume than hedge funds. And they say we're all dumb money, but we've identified some of the best performing stocks over the last couple of years, like Tesla, Palantir, Coinbase, Robinhood, and many others. In fact, retail traders were so powerful, they had to literally turn off the buy button on brokers to stop us buying GameStop, as we're all squeezing Ken Griffin and his buddies into the ground, when retail volume was even bigger back in the meme bubble years, 2020 and 2021. And so again, there's room for us to grow here. I think before this secular bull's finally over, whenever it is over, next year, 5 years, 10 years, who knows? I think this number could end up being 35, even 40%, with of course market makers still a big portion of volume, having to take the other side of most of our trades. So don't underestimate the collective power of us retail traders, nor the wisdom either. With all financial data now being made widely available, the informational gap between retail traders and hedge funds has closed a lot, not to mention a lot of us invest off vibes as well, which has proven to be just as good a strategy as trying to find a stock with a low PE or something simplistic like that. And you wouldn't believe it, even though we've been on a good multi-year run for mega cap tech now, what's done even better since stocks bottomed in late 22 is European banks. And that's actually accelerated this year as big institutional investors have rotated out of the States weights into Euro stocks. And believe it or not, there's an ETF for that listed on the Nasdaq. EUFN, iShares, MSCI Europe Financials ETF. But before you go thinking they're an exceptional asset, let me just show you a long-term chart. There's a 3-monthly chart, which they just only broke out to all-time highs last quarter after consolidating for 15 years. So it's probably about time they broke out. But what I think is a lot more innovative and has a lot more potential than European banks is the company leading the charge into the robotics revolution, Tesla. For the first time ever today, they just delivered a car autonomously straight from the factory to a customer in Austin, Texas, using unsupervised FSD, which is a big catalyst for the company in addition to Robotaxi that is launched in the same city. Next year, hopefully, we've got Optimist bots running from the factory to customer homes as well by themselves. Maybe not, but wouldn't that be cool? And there's a look at the daily on Tesla. Had a good start to the week after a successful Robotaxi launch, but we've pulled back and coiled up here. Whilst competitor, Uber's actually done better. People were thinking this was going to sell off because Tesla's coming for them. But they've partnered with Google's Waymo, and I think they've positioned themselves perfectly. And it looks like this market's shaping up to be dominated by Google, Uber, and Tesla. And it's not only going to dramatically change the taxi industry, it's going to grow it because it's going to become a lot cheaper. And I do believe the secular trend of most people owning less and less cars going forward. And I do think even in 10 years or so, it might actually be a niche to own a car. Because if you can get around town for a fraction of the price, whilst not having to drive, whilst not having to find and pay for a park, get to wherever you want for $5-10, I mean, why wouldn't you? And that's one of the things I really like about Google. They've got a really good spot at the robo-taxi table. And I think the market's completely discounted them when it comes to AI. And we actually just heard today, OpenAI, who's behind GPT, taps Google Cloud TPUs in a bid to diversify their AI chip supply. And that's Tensor Processing Unit, another way to run artificial intelligence. And this is probably something most people wouldn't even realize Google's in. And I'd say most people wouldn't even realize when statistically measured, Google actually has the most efficient AI model and is well out in front compared to the others. Looking here at Polymarket, which company has the best AI model at the end of this year? Google, 60%. As Gemini has made leaps and bounds of late, it really is good. I'd encourage you to check it out, compare some queries with that of GPT and Grok as well. Me personally, I use all three as I find some of them are better for certain things than others, but I've noticed a definite improvement in Gemini this past month or so. And that's just one reason why it remains one of my largest positions in my long-term portfolio. And like I told you guys back on the 7th of May, after the market freaked out on Apple potentially developing its own search engine, then it freaked out again last week, apparently on Turkish regulators trying to come after them, which I kind of found hard to believe. Once again, I told you guys I thought it was great value. And here we are ripping up today and just going down to a 5-minute chart. It was interesting. The big rip came in the last 10 minutes of the day. Some big money trying to get in there before the weekend, likely helped by that news of OpenAI getting their TPUs. And just going out to a monthly chart, compared to a lot of other stocks, Google's pretty much consolidated for the last 4 years. In fact, it's only up a bit over 20% since its 21 highs. Got a forward PE of 17. Get a forward earnings yield over 5% on Alphabet Google. And you can be a part owner of Waymo, Android, Chrome, YouTube. Not to mention they're the most profitable company in the world. They have the cash flow to finance big ambitions, not only into AI robotaxis, but also robotics. And I think Gemini could surprise a lot of people and actually come out on top of GPT, especially when they dial it in with a smartphone app, and they'll be able to monetize chatbots better than anybody else. They've already got the advertising infrastructure and customers there ready to go. And now, given the fact that they have the best AI model out there, I think it's just a matter of time. And the market, like we see quite often, could re-rate this, and quickly so. Just like we've seen in AMD over the last couple of months, after everybody wrote it off for dead, calling it the advanced money destroyer. And what other industry is going to be a big beneficiary of this AI boom and huge need to process and store data is nuclear. Expect to see more deregulation and political tailwind for power supply and nuclear generation. They're really going to loosen it up. And that's because they need to add more capacity equal to 3 New York cities within the next 4.5 years. That's incredible growth. And I think that's why we're already seeing the likes of uranium on a strong rip here. The market's waking up to this reality. Something else I've been talking about for well over a year now, which is helping to power the largest uranium miner in the world, Cameco. Again, monster volumes coming in. And why we've been seeing the same on these modern day small modular reactor companies like Oklo and NuScale Power, ticker symbol SMR. Currently having a bit of a pullback this week, but overall it's been a pretty good week for small growth-led names. Another stock I hold, Microvast, is doing really well for me and my Stock Picks members, up over 100% since I bought it earlier this year. And it too, seeing good volume today. That's what we like to see. These big volume thrusts pushing the price higher. And even though it was a pretty soft day for a lot of these smaller names, we're still seeing some of them hold up pretty well. Quantum. QUBT appears to be getting defended here. Another stock I own, Personalis, doing well for me and my stock picks members today. eVTOL and drone stocks also been doing well of late. Kratos Defense ripping up 10% today. Another one that's been picking up and a retail favorite, Lemonade. Keep an eye on this one. I think it has a lot of potential. And some of these fintechs and new age finance and insurance companies have just been doing remarkably well, with Sezzle being our best performing pick of late. But another one that's been doing good for us, you may not have heard of, Oddity Technology, one of the best performing stocks on this watch list today. This is one I gave out to my stock picks members on the 4th of May after they came out with a really good earnings result. They're a fast growing online beauty retailer with a unique direct-to-consumer business model. We're already up over 22% on it, with it close to breaking out to brand new all-time highs again today, and I'm just letting my trend-following model guide me on when to sell. And I've been working on my next pick that I send out every Sunday morning to members, and this one is fire. I think it can easily double within the next couple of months, given the industry it's in and the growth it's recently experienced, and the fact that a lot of retail traders still don't know about it yet. And if you want to receive my deep dive report on that in your inboxes Sunday morning, then click the link below this video and you'll get an email that looks like this every Sunday morning in your inbox. And this is the one for Oddity Tech I sent out on the 5th of May. And like I told my members back then, I could see the market was coming back. I wanted to add more tech companies to my portfolio, and this one stood out to me when I scanned the market every week looking for new opportunities. I always give an introduction. I write an easy to understand English with a link to my deep dive report, which looks like this. It's a PDF document. I give an overview of the stock, its details, exactly what they do, along with a link to their latest investor presentation if you want to learn more about the company. But I also explain exactly why I like them with clear bullet points and simple English, along with their latest numbers, my technical analysis of the chart. As I'm doing a trend following strategy, I'm focused on finding undiscovered stocks that are breaking out to highs and then using my trend following model to keep me in. I'll also explain what the risks could be and finish with a bullish thesis. And inside the stock picks members area, you can see details of all my current 22 open picks, a lot of stocks I've never talked about in these videos, and with links to all of my deep dive reports on them, along with insights and analytics on my portfolio and transparent performance stats updated every week. Because unlike others on here, I only sell what I use myself. I invest in every single pick I send out to members the day after I send out the report. And I track my real money brokerage account I've dedicated to this service in the members area with a goal of turning it into $1 million in under 10 years. And so if you want to get my next pick this Sunday morning, stock I'm really excited about, then click the link below this video, head on over to my website, clickcapital.io, and jump on board my stock pick service today by using code JUN30 to lock in your permanent 30% discount before it expires this weekend. And this is your last chance to hop on board now, because I'm not going to be offering a 30% discount anytime soon, I can promise you that. And I also had somebody reach out to me yesterday and ask, can I do a package deal to get my stock picks and my custom indicators? And these are the ones you see me use every day on my charts, all my technical ones and my fundamental ones as well, like stock fair value, shareholder yield. You won't find these anywhere else. Nobody else has got the shareholder yield indicator on TradingView, along with many other ones of mine. And so if you want to get both my stock picks and custom indicators and save even more, then head on over to clickcapital.io/deal, and you can also use the coupon code JUN30 on top of these already discounted prices. And you can choose either a monthly or yearly plan, which gives you 2 months free. But if you want the biggest saving and you don't want a subscription, then I recommend getting a lifetime membership to my stock picks. All my custom indicators and any ones I develop in the future, you'll get for free, as well as I usually come out with a couple of new ones every year. And again, you can use the coupon code JUN30 on this price as well. So you'll pay just over $2,000 with no ongoing costs. And I've already had a few people sign up to my stock picks and indicators these past few days, and I've just added this package deal. So if you're one of those people and you want to upgrade to a package deal, then just email support@clickcapital.io and we'll sort you out, so you can just pay the difference from what you've already paid, and you can get my indicators and picks as well if you want to upgrade to a lifetime membership. And I do offer a 7-day refund if you want to get in there and have a look and see if it's for you. You can do that risk-free. But if you want to lock in a 30% discount, then you need to jump on board today before this code expires. And just getting back into some macro news and data, we saw a little bit of a rebound in consumer sentiment today after it really came off the last couple of prints. Big fears and worries about tariffs. Final reading for June came in at 60.7, pretty good jump from 52 in May. So consumers are feeling a little bit better, but they're still a little bit on edge, cutting spending on some discretionary items like cars and restaurants, as there's still plenty of worry and doubt about tariffs and what they could do, as it's still really all up in the air. But the fact is, tariffs are just not showing up in inflation. Looking at the hard data, we got PCE coming today in line as expected on the headline print, 0.1% month over month, 2.3 year over year, a touch higher on core inflation, but just looking at the past 3 months annualized, that is getting down to multi-year lows. And there's a look at the latest print, hardly a breakout on the chart, right? I mean, if we printed something up here or here, sure, let's talk about keeping rates on hold. And it was funny, someone said to me yesterday, I should be the Fed chair, for which I said I'd cut rates right away to where inflation is, 2.3%, and send it on the economy and markets, not to mention helping out millions of consumers. And that would be my policy for interest rates if I was Fed chair. You wouldn't even need me there. Wouldn't have to be any politics. Inflation goes higher, so do interest rates. If inflation goes lower, so does interest rates. No need to guess or speculate. Just make the cost of capital the same as inflation. Whenever inflation gets hot, cost of capital goes up, it's going to cool it down. Inflation is cool, so does the cost of capital come down, stimulate growth again. But Jay Powell appears to have other ideas, which are going strongly against not only the White House, but also the market, as they're only pricing in about a 7% chance the Fed's going to stay on hold in September. And I agree with these odds as well. I'd be surprised if they don't cut in September. I think even next month, it could be up in the air. Like some Fed officials are actually thinking as well, bit of a division within the ranks. And it's actually been 32 years since we've seen 2 Fed Reserve governors dissent from a rate decision, but it could happen next month. With them going against Jay Powell, who wants to stay on hold for some reason. He thinks tariffs might increase inflation at some point. Fact is, we're in a global monetary easing cycle, liquidity boom. We've seen 64 rate cuts globally so far this year, none in the States. And if we keep tracking like this, we could be on a similar path to last year in 2020, which were actually really good years in the stock market. And so the pressure's building on Powell from all corners, not just the president. And so the next Fed meeting should be a juicy one. And as I shared with my options trading members in our chat room, I'm betting on them cutting in September, as I got in at an average 46% odds, which has already gone up quite a bit since then, but still below where Fed Fund futures are pricing in. And if you want to get my options trades in real time, then join the Market Makers Kit. You can also use code JUN30 and get access to our chat room, where I also share my prediction market bets, and I'm also active in the last hour of the US trading session, sharing my trades, reasoning, and screenshots straight from my trading account with members in real time, which has also been getting a lot of great feedback. Thanks to everybody who's joined so far. And just looking at the latest on tariffs coming into play as we approach the end of the 90-day pause. We just heard Canada come out and say they're going to slap a digital services tax on US tech firms, something similar to what we've seen in Europe. That's caused a sharp rebuttal from the president, saying they are now stopping all trade talks with Canada, and they'll be letting them know what tariffs they'll be paying to do business with states. Thank you for your attention to this matter. And likely to open a probe. I'm not sure what angle the Canadian government is going for here, especially the timing on this. They should have waited until they got a trade deal to come out with this, but we'll see how it all plays out. And I think the tariff deadline is going to be a nothing burger as well, as the White House is super flexible on this. If the market sells off, they'll just rejig it and we'll get another bounce back. And like Scott Bessent said, they're likely to do extensions. We're going to get trade deals. It's just a matter of when. The effective rate will end up being somewhere around 15%, which again, shouldn't be a big material thing. It's actually already generating a lot of revenue for the US government. And China did confirm the details of a US trade deal. So that looks like it's pretty much a done deal. And we've got India and the European Union ready to sign next as well. So it looks like the market correctly saw all this coming and discounted it. And in fact, ever since we got that surprise news from US and China coming out of Geneva on the weekend, 11th May, S&P 500 gapped up above its 200-day moving average and has defended it ever since. And finally, a look at the calendar for next week. Just a few bits and bobs still outside the thick of an earnings season. The real big one will be the jobs report, which usually comes out on the first Friday of every month. But next Friday is the 4th of July, which is Independence Day, a national holiday in the United States when markets are closed, as most Americans get together and celebrate becoming a republic, marking their separation from British rule back in 1776. Basically represents the birth of the states, celebrated with fireworks, flags, barbecues. It's a big one. And just wrapping it up, looking at the VIX, market calling up here. Look at this, 16.33. Like I said, we could still have further room to grind down into the 15s, 14s, who knows, even towards 12. Like I said, back in the bull market 2013 to 2018, we even briefly touched the high 8s. Still plenty of room for volatility to be sucked out of this market, and many investors still on the sidelines, big and small. So I do think we have room to melt up. Market seems to be shaking off everything with ease. And I mean, you'll never see me bearish at all-time highs. Many of you guys know I'm a perma bull. I've always been, always will be. And that's because most of the money is made on the upside, not being scared out onto the sidelines. And I also love trading options and most recently prediction markets as well, which actually trade just like a stock exchange. And if you want to be a part of that and trade with me live every day, then now's your chance to save 30% for the code JUN30 expires this weekend. Just click the link below this video, head on over to clickcapital.io and join the Market Makers Kit if you're into trading options. Otherwise, if you want to get my weekly stock picks and custom trading indicators, then I highly recommend taking advantage of a lifetime membership and using code JUN30 to discount this price even further. That'll be your biggest saving. Otherwise, have a great weekend and I'll see you back here again come Monday night. Cheers.